this afternoon for our May investment update. We are continuing to live in interesting times. I'm joined today by my colleagues James, Jeff and Annie from the investment team. The usual idea for our monthly update, we're going to be talking through a little bit about what's been happening in the financial markets, what we've been making changes-wise in our model portfolios, and then starting to take a little bit of a look ahead at what we're trying to do from a strategy perspective as we continue to battle against the impacts of the virus as they resonate around the world. I think what we're looking at as we sort of glance an eye across the entire landscape seems to be central banks who are trying to buy up as much debt issuance as they can, and markets moving higher on the ongoing promises of additional stimulus and support. So one of the other topics that we're going to try and address is what exactly does a balanced portfolio look in this kind of post-COVID-19 world. So just to sort of get on with some of the slides, I'm going to make some of my co-panelists slightly nervous and get the wrath of marketing for this for not respecting the integrity of the slide deck. But what I do want to do is skip onto this concept of the portfolio to then actually come back and look at what we've been doing performance-wise, because I think it's easier to talk about what performance has been when you can actually see some underlying constituents of the portfolio. So just to sort of have a little look at, this is for us our standard balanced portfolio. I know that there's quite a lot of information on the slide, so just to sort of pick out a couple of key highlights, for a balanced portfolio, sitting with 6% in equities is incredibly low and very, very different from a lot of our peer group. And then looking up at the fixed income component, with a growing number of names sitting under this cash liquidity management section, we are continuing to be incredibly defensively positioned as we came into 2020. We were fortunate enough to have a very, very low equity allocation at the start of the year. And although we've started growing that, we are coming from very low levels. So just to sort of skip at looking at how we were positioned at the beginning versus as at the end of April, you can see some what look like quite sizable changes from both an allocation to cash and an allocation to fixed income perspective. Essentially what's happened from our side is, as the central banks have been cutting interest rates, we've kind of been put in a position where we're having to continue to adapt new strategies and adopt new strategies and adapt our existing strategies. So we've kind of been rotating out of the short-dated government fixed income holdings and moving across to the investment grade, which is now listed as 57% of our dollar balanced models. That, if I skip forward a slide again, the joys of having control of the slide deck, you can see at the top section where we're holding a small number of short-dated, high-quality investment grade bonds. So with the scale of our defensiveness from a positioning perspective, now I can go back to the front of the deck and we can kind of continue as if we're just starting now. We had positive performance across the board for all of our global multi-asset models in April. That's unsurprising given the scale of the market rally, something that we'll be talking a little bit in the equity section. And as we've been moving across and adjusting some of our fixed income holdings, we've seen in the sterling conservative, for example, some very strong performance numbers, and that's because of some of the actions that we've seen from a central bank perspective. So we have seen quite a few different movements, but with the S&P 500 having one of its strongest months for many decades, coming in up just over 12.5%, coming off of one of its worst months for decades. It has been an incredibly volatile market for, I think, almost everybody, and there has continued to be very few asset classes that haven't got substantial amounts of volatility. So just to sort of try and move forward, there are three things that I wanted just to highlight. On a year-to-date basis, we've got a number of our model portfolios that are continuing to be in positive territory on a month-to-date basis. That's something that we're quite proud of and reflective of the very defensive positioning that we had at the start of the year. But coming back to the portfolio, there's just three things that I wanted to highlight. Number one, our equity exposure is entirely consisting of some satellite holdings. So one of the big decisions that we have to make as an investment management team here at Dolfin is at what point do we want to re-establish some core equity exposure back into our models. So that's, I think, one thing. I'm not going to go on too much into the holdings because we'll cover that a bit more in the equity sector. Point number two, which I kind of briefly touched on, is in relation to the fixed income holdings. We have been continually ahead of the curve over the last couple of months in terms of changing the holdings in the portfolio to try and minimize declines. But when the central banks come out and are doing multiple intra-meeting rate cuts, we've had to completely change the fixed income component of our portfolio. And that kind of leads me on to point number three. I've put up a dollar balanced portfolio. One of our big discussion points is what is the concept of a dollar balanced portfolio looking forward. We are in a position where it's very, very difficult to find any positive real yielding developed market government bond, and equities, which we'll come on to, are looking incredibly expensive from a valuation perspective as well. So from a perspective of a private client looking at the world, how do you have this balance in my portfolio when I'm stuck between owning overvalued equities or essentially zero yielding government bonds? Where do I want to take the risk, and how much volatility am I comfortable accepting, both in my portfolio and from our perspective in the models? So I think before I pass on to James, and he doesn't know I'm doing this, so this is a little bit of extra fun for me. One of the things that James is kind of known for on the team is this idea of, do we want to hold this portfolio today? As we wake up and as we start a new day, and at the moment, every day has been very, very different. The idea of, are we owning what we want to own today in the current market environment? The short answer to that question is yes. We've obviously, in hindsight, a little bit more equity exposure in April would have been perfect. But where we are very comfortable, given our focus on absolute return, given that we're focused on trying to buy companies and positions that we want to own rather than trying to keep up with our peer group. Right now, this is where we believe is the best position to be allocated for a US dollar balanced mandate. It is very different from a lot of our peer group. We are continuing to evolve some of the holdings. And we're going to talk you through, Jeff is going to talk you through a little bit more on the fixed income, what he's been working on the coronavirus basket from his side. And we're going to cover in a bit more detail the rationale behind some of the equity holdings. But I'm finally going to allow James the opportunity to speak. So I'm going to pass across to him just to give you some top level thoughts on macro. Before I do, we're going to pause periodically to try and address any questions that come up. There's a question and answer facility within the webinar. So if you do have any questions, please feel free to write them in, and we will try and address them as we go. There are also, there's a little bit of time for questions at the end, so we can come back to them. We have had a couple of pre-submitted questions, so thank you for those. And we'll try and incorporate them and adopt them into what we're saying as we go through. But without further ado, I will hand you across to James.
Thank you very much. These are unprecedented times. So we are experiencing a macroeconomic series of shocks that we've not really had to deal with in the past, certainly not in modern economic history. And so for that reason, I think a lot of people have been scrambling to try and wrap their heads around what's happened and what this points to as far as economic growth and as far as valuations. We have to start with the coronavirus and the sort of the rolling wave that the virus has taken from east to west as it's traveled the globe. The virus started in China. And in early in 2020, that was when we saw the real explosion of cases in China. The Chinese reacted very, very quickly. They were first to implement lockdown restrictions, and they went very aggressive in the lockdown restrictions that they implemented. And so for that reason, the infection rate in China, which you'll see on the left-hand part of this slide in front of you, leveled off fairly quickly. There's all sorts of questions as to the accuracy of data in China and the US and the rest of the world. But for the moment, let's just take the data as it is. So the Chinese saw quite a lot of success in bringing the virus under control from an early stage, but this has come at the price of a consistently rigid set of controls on economic and social activity in order to constrain potential infection rates. As the virus has rolled across Eurasia, Europe was the next to be hit. The Europeans, or within the Eurozone, there were varying degrees of measures that were taken at varying moments. But in general, the Europeans have adopted probably the most stringent, in some cases, controls on activity as a way of bringing the virus under control. And then finally, we have the US. The US was late to introduce controls, and the controls that the US has introduced had been somewhat more modest than the ones that were introduced in the Eurozone. And this rolling path of varying policy responses as far as the virus itself is concerned goes a long way to explaining the differentials that we're seeing in the pace of economic activity. So if we look at current economic activity, the next slide please, Simon, as measured by, in this case, this is the Goldman Sachs Current Activity Index, which I find to be an extremely useful, close to real-time measure of economic activity that's comparable on a global basis, just because of the way it's constructed. What you can see first is that the contraction in activity has been absolutely breathtaking. So almost on a dime, the world just stopped and has slowed to a pace, or has shrunk at a pace we haven't seen since the global financial crisis a decade ago. The Chinese clearly fell first, and they clearly fell furthest. So the differential between the pace of Chinese growth or activity prior to this, to the recession from the coronavirus and the trout is a full 25% percentage points. Europe was the next to get hit. Europe has been hit not as hard in economic terms thus far, and there are some hopes that the pace of declines in Europe is now starting to moderate as the European economies are starting to be unlocked. The US is next in line in this rolling wave of virus-related slowdowns. The hit to the US is severe, but I don't think the hit has been fully absorbed yet. As a result, we're getting some very, very negative data points that are only going to get worse. I was looking today at the non-farm payrolls that we're looking to see tomorrow, and the numbers that we're talking about now are, at extraordinary levels, and may not even be as bad as the really as the underlying circumstances really are. So we're now starting to trace the bottom of the economic downturn that began in China, has rotated through Europe, and now is finishing up in North America, in the US. What we don't really know or have a clear idea on yet is where we go next. So if we just advance one slide, in the fixed income market, what we can see really clearly is the impact of a lot of the policy that has been implemented by central banks and by governments in order to mitigate the economic damage that's been done by the cessation of activity related to the coronavirus. So if you look at loan loss provisions that have been put in place on the part of regional banks in the United States, you can see that they've surged above $10 billion, which is well above, which is already above the peaks that were reached in the depths of the 2008-2009 recession. And these loan loss provisions are only likely to further accelerate. What banks are telling us, regional banks, the local banks that lend to small and medium enterprises in the US, what they're telling us is that they expect bankruptcies and they expect defaults. And that's what they're getting ready for. If you look at the investment grade market in the credit market, however, IG spreads at about 270 are 2.7 are actually not terribly inflated relative to what we saw in the 2008-2009 recession. IG spreads have come down quite a bit from the levels we saw about a month ago. And this is a reflection of the Federal Reserve stepping in and providing a backstop on the credit markets. Banks are telling you something very important about the real economy, which is that there is going to be a wave of bankruptcies and a wave of defaults. And this is going to be an economic shock, which is going to ripple and percolate throughout the economy in the quarters and perhaps even years to come. We're going to see the same thing in the jobs market. The non-farm payrolls number, is looking like 21 million. We're looking at 16% unemployment for the month of April, and that's probably not going to mark the bottom. These are truly enormous numbers, and these are not going to be followed by any swift return of people back into the workforce. So if you take all of this together, what we're looking at is an extended period of economic strain, which I think the global economy is going to struggle to come out of smoothly. It's not going to look like a V-shaped recovery. I think the lion's share of attention is rightly being placed on the bond market right now and on how the Federal Reserve and other central banks have been responding to this crisis. And so on that note, I'd like to hand it over to my colleague, Jeff, to talk a little bit more about the fixed income market.
Thank you, James. Yeah, so if we start off with the Federal Reserve, if we look at this chart, as of early March, the balance sheet of the Fed stood at just over 4.2 trillion. And in the past 30 days alone, the Fed's already printed some 2 trillion. And in this cycle, we expect the Fed to print more treasuries than it did in the iteration of QE 1, 2, and 3 combined. Now, through our own assessment of the impact of the balance sheet expansion, we can see 4 implications. First of all, rates will have to stay low to allow government debt to be serviced and avoid an event like the taper tantrum that we witnessed a few years ago. The Fed may potentially adopt yield curve control, as we've already seen in Japan. And the search for yield means that in order for investment and fund managers to meet investment objectives, it will force private investors to reach down the capital structure into lower quality investment grade and high yield bonds. And the fourth, the unwanted consequence of this is the potential creation of so-called zombie companies, as the Fed does everything it can to keep alive every company and institution with copious amounts of debt. Now, the supply pressure, we think, will have most impact on the long end of the curve once things do actually normalize. But if we move one slide ahead and look at the size of the central bank's purchase program in relation to net issuance. Now, issuance has been very strong in both the investment grade and high yield markets this past month. We actually saw a new record set in the IG markets, and high yield issuance this past month was at a 3-month high. And that's mostly to address upcoming maturities, but nevertheless, net issuance after redemptions has still been very strong. And if I just remind you of the size of the Fed support, we're expecting 750 billion in total, 500 billion for the primary market corporate credit facility and 250 billion for the secondary facility. And we had a little bit of clarity from the Fed this week that they'll actually begin buying ETFs in early May, and the corporate credit facilities will start buying soon after that. And this is 6 weeks after the initial announcement. But clearly the pledge from the Fed and that backstop that they'll provide has already had a resounding positive impact on the markets. Now, the ECB this week, they didn't expand its bond buying program, not this time around at least, but we believe it's ready to act in any case of any souring market sentiment. And we think the central banks buying will help supply and demand balance in the investment grade side, and it gives us a green light from the technical perspective. Now, there are two baskets that we're building. First of all, is the resilience basket. If you look at this chart, I'm focusing on USRG to begin with, and we're looking at total returns, ranked with the strongest performance on the left and the weakest on the right. And you can see that the drivers, the sectors that have outperformed include healthcare, utilities, telecom, and technology. The first two are historically defensive sectors, given the relatively inelastic demand for medicine and also electricity. And for our portfolios, we're just as much focused on generating returns as we are in protecting capital. So we're really focusing on which sectors will be able to continue to perform in the event that after lockdown measures are lifted, and if there are any potential spillover effects, these sectors will still hold up well, since they've already been tested and tried in the month of March. So we like the pharmaceutical space. It's an area perceived to be providing the solution to this crisis. Telecoms as well, we think that the COVID impact will be manageable. And in tech, I'd just like to highlight one particular credit that stands out to us that we've started to include in our portfolios, and that's the hard disk drive manufacturer Seagate. Now, HDD provides a vital role in mass capacity storage for both cloud and also hyperscale companies. And Seagate's first quarter results were excellent. In fact, they comfortably beat street expectations. And they're one of the very few companies that actually maintain their guidance for the full year as well. And this drive towards working from home initiatives and the remote economy has really accelerated demand for HDD, and we think it will continue to provide a boon for the HDD market through into the second quarter as well. And if we just move on one further to look at our recovery basket, defaults is, it's been the buzzword. Everyone's focusing on where it's heading. As of the month end in April, we saw in the US high yield market, defaults had actually reached up to 4%. And there's been great concentration of defaults in particular sectors, namely energy, where in the past month we saw Whiting Petroleum, Diamond Offshore as well, file for Chapter 11. Frontier Communications, which has been struggling with subscriber numbers, also filed last month. And what we're focusing on in order to avoid these spots of weakness is actually look at a company's liquidity relative to its short-term debt in order to avoid missing coupon payments and going down that road of bankruptcy. Now, if we look at this chart, across the x-axis, the companies on the left have the greatest liquidity need when viewed in relation to its upcoming 2020 and 2021 debt obligations. And however, there's actually a second dimension which we think will also affect default rates, and that's the expected decline in earnings, which we have along the y-axis. Now, compounding the two, the sectors which we think are worse positioned will be oil and gas and airlines, where the EBITDA decline under a stress scenario is the worst, and also it has the greatest liquidity needs to meet its maturities. Now, at the very other end of the spectrum, this is what's helped build our recovery basket. We like those names that are within that green oval. We've got utilities again, telecom, healthcare, also food and beverage, which has stood out as a sector that's particularly outperformed. And we think these areas, they'll be most able to meet upcoming debt repayment, and they'll have the lowest expected magnitude of decline to their earnings as well. But we're not just focusing on a sector basis. In building this recovery basket, we're also finding single names that stand out. One name that we've already addressed through our investment committee is Claris Global. It's a manufacturer of aftermarket car batteries, and we think that as the market for new passenger cars collapses, which we've seen in all three of the major markets, the US, Europe, and China, we think that drivers will keep their cars for longer. And naturally, this will help to provide a boom for demand for batteries. Now, Clarius, they generate strong positive free cash flow, even under stress scenarios. And the company has no meaningful debt maturities until 2026, which gives management plenty of runway to focus on improving its cost structure, creating value for the company and for stakeholders, as opposed to having to worry about their debt obligations. So this is how we're building our recovery basket. There are more names that will be included as we want to build a diversified portfolio. And if we just move on to the next slide, which wraps up our positioning. In April, fixed income investors began to rotate slowly but surely back into risk assets, where we saw corporate bonds comfortably outperforming the government bond markets. Now, you can see that we've got an underweight position across all government bonds, and that's because we don't think that the low carry will actually compensate us for any downside as it pertains to loss in principal for investors. And with the large expected supply glut, we think that, if anything, pressure on yield curves will be biased upwards. Also, again, the Eurozone market, it's awash with negative yielding bonds. But we do like the investment grade space. Now we see that attractive yields, and the Fed's backstop really provides strong support, particularly for that crossover BBB, BB segment, where we also see sufficient liquidity as well. So we're not burning away any performance through trading costs. And then very finally, emerging markets, we're still heeding with caution because of the expected strengthening of the US dollar. Also, lower commodity prices will affect export economies that are heavily dependent on the prices of commodities. And finally, we think that the demand shock that we see from lower consumer sentiment in developed markets hasn't been fully priced in. And I just want to give an example. Pemex is an EM credit that fell into high yield last month, and Pemex faces a lot of difficulties when it comes to asset sales. It's unable to cut a dividend, and we think it's unlikely that it will issue secured debt, as it will end up granting collateral to foreign investors. And given the COVID impact, which has already impacted the Mexican economy through a downgrade from the ratings agencies, we think there will also be lower ability for the government to infuse cash into Pemex as well. So that also leads to our continued underweight positioning in emerging markets. Thanks, back to you, James.
Now what we're going to do is we're going to switch over to the equity part of our presentation. Annie Giavelli, if we could, if I could hand it over to you and we could have a look at what has been going on in the single stocks part of our portfolio, please.
Yeah. To follow up from our previous investment update, we've constructed the coronavirus resilience basket, and out of 10 stocks, actually 4 of them have recently reported earnings. So I'm just going to talk you through briefly about the updates about these 4 companies. So let's start with Amazon. Amazon has reported strong revenues above street consensus. The market is reacting really positively to the recent hiring plan of 175,000 employees to meet the increasing e-commerce demand. I mean, it has been one of our favorite topics, not just on investment side, but also, on the daily conversations. We did have an investment talk about e-commerce, and we talk about how, we have been heavily relying on the Amazon deliveries for both essential and non-essential items. Well, including myself, who has been definitely spending more money on Amazon also. So despite a short-term cost pressure for sure due to the coronavirus, we still do believe that companies' long-term growth will be driven by acceleration of the consumer adoption of e-commerce, but also the enterprise adoption in cloud computing, and the company has invested more in the infrastructure. So we are still positive on the company, and we think all these factors that I've just mentioned will drive up the share price. And then to follow, MasterCard has also reported better than expected revenues. So now that we have had, sorry, if you go back to the previous slide. Now that we have had more information on the e-commerce sector growth, which also support our view of a permanent shift in this direction, we think this will support the future growth of the company. So we do see like MasterCard, and we have highlighted many positives before, such as the strong market position, strong pricing power, and also all the sector growth factors, just like the digital e-commerce and how the online transactions have been increasing. And we also did mention, during our e-commerce talk that, the world is actually moving towards a cashless model. So we think the MasterCard operation will remain solid. And yeah, and especially after the Net acquisition, we think that will also, which will close the next quarter, that also will contribute to the extra revenue generation. And the third company that has reported earnings is Alphabet, which is also one of our favorite names. I mean, we all have been consuming one content online, live streaming and YouTube actually is one of the main revenue generation stream for the company. So we've been seeing so the revenue coming from YouTube advertisement and YouTube subscription have been driving the growth of the company. And Google Cloud also remains really robust, has achieved more than 50% of the growth year on year. So the overall outlook remains positive. That is so yeah. So that's the updates about the company have reported earnings on the resilient basket, and then I'm going to hand it back to James to talk about the macro side.
So one of the aspects of the current market environment that I wanted to bring to everybody's attention. Generals fight the last war and investors trade the last recession. It's just the way human psychology works. It's the way people work. And one of the things I'm very aware of is that in the current lockdown recession and the sell-off related to coronavirus, it's natural for people to compare this to the global financial crisis that was 10 years ago. It's a perfectly reasonable kind of comparison to make. It's the one that sticks most in our head. Now, we saw a really dramatic sell-off in March in equity markets. And what I'm showing you here is the MSCI World. Now, that sell-off in March was actually very similar in scale and in scope, and speed and in scope, to the sell-off that we had in the fourth quarter in 2008. And if you might recall, what had happened was that we were going through the mortgage crisis. Markets were under pressure, but then as the TARP came to the U.S. Congress, it ran into a bit of a roadblock, and immediately markets capitulated. So that capitulation in 2008 looked a lot like the equity capitulation we saw in 2020. Here's the problem. The capitulation in 2008 came after markets had already taken 20% off of valuations. Markets were trading the mortgage crisis. Markets were trading Bear Stearns going under and real recession that was hitting well before the kind of sell-off that we had this year in March. So this year was coming from the market highs. The second thing I just want everybody to sort of remain focused on is that similar to the sell-off in 2008, there was a capitulation and then there was a bounce. But in 2008, that bounce was followed by another trade lower and then another trend lower, so that we didn't actually hit the bottom of the market until March of 2009. And if I look at where we are today, it feels like we haven't yet experienced that second half or that third perhaps of the market move. So what we've got right now is the steepest recession, the most painful economic environment that we've had in anybody's living memory, certainly since World War II. An equity market which has traded off sharply, but did so from record highs, not from levels which already reflected the economic stress that was coming. And that is currently treading water, but it's still fairly robust levels. Whereas historically, what we would have expected would have been for another move lower and for further lows to be reached in months to come. And I think that what's happening here is that markets are very confused as to what kind of earnings they need to be taking in and absorbing in order to figure out what the right PE and thus what the right price is. So it really does come down to earnings and the confusion surrounding that. So on that note, what I'd like to do is then pass it back to Simon, hopefully. A little bit of a closer look at the earnings outlook.
Just on the earnings front, what we've seen, and you can kind of see on the left-hand side with the 2020 earnings decline. If you look at sort of over the last 8-9 years of earnings expectations that are on, analysts always start off a little bit over-optimistic, and then gradually those expectations slowly get drawn down over the course of the year. In 2020, we've obviously seen a much steeper decline. I think from our side, one of the obvious aspects of this is it's not over yet. What's going to determine the length of that decline is going to be how long we're all going to be sitting in some sort of lockdown, how long social distancing is going to be in place. But when we start getting beyond that and we slowly start unlocking the economies, the bigger question for us and what we're spending time talking about is more focused on how this is going to change our consumption patterns and behavior, and how long before we as individuals are happy getting on an airplane with our families and going to stay in a hotel in another country. So when we're trying to sort of pull this into where do we want to be exposed from an equity perspective, what we're seeing is, we're looking at an index here. There are companies that haven't had that impact from a revenue perspective, and this kind of comes back to this notion of core versus satellite equities, and where do we want to have control, and having the ability to be much more selective about how much equity exposure we have, and more importantly, where we have that. Just to sort of peek on the right-hand side where we've got Europe, you can see obviously the decline in Europe has been much more severe than in the US. The US has had a lot of share buybacks, which helps EPS levels. It's had a lot more central bank support than in Europe. So you've kind of seen earnings rallying fairly consistently over the last 8 or 9 years. In Europe, it's not really had that same style of growth in earnings. So when you're seeing earnings starting to decline and starting to pull back, we're going down below 2013, 2014 levels. So again, from our perspective, it kind of brings out, are the equity markets trading at those sorts of levels, or are they trading significantly higher? And how much further have those earnings revisions got to go? Because it's earnings that we're kind of looking at when we're starting to look at things from a valuations perspective as well. Moving across to the valuations argument, and I'm hoping if it's Aaliyah that has control, we skip across to the next slide. The valuations concept from our perspective is, do we feel comfortable right now paying 19 and a half times current earnings to own equities? The answer from our perspective is no. That's why we're not sitting on core equity exposure. But if you cast your eye down the table on the right-hand side, and the sort of the spread of sectors that we've got in the S&P 500 and the range of forward-looking price earnings ratios, you can see there's the energy one is skewed because so many of them are not making money anymore. But there's a huge range of valuations that exist within the index valuation. Bottom left, Amazon. What we've been talking about, and this idea of, can you buy S&P 500 with a forward PE ratio of 19.5? That's expensive. Amazon, could you buy Amazon with a forward PE ratio of 100? Because plenty of people did in 2015, and those that did have had handsome returns being paid to them. And I think this comes back to what we've titled this slide as the new abnormal, what we're going to be discussing in a bit more detail next week, but in terms of what is a fair level of valuations, when this comes back to the idea of what is a balanced portfolio. I think the virus has proven to be a catalyst for a lot of different aspects. It's changed a lot of what we're doing from an everyday life and an interaction perspective. The question that we've been discussing is, well, has it changed what you should accept as a valuation for equities? Should we be comfortable buying at higher levels just because there is a lack of alternatives, because debt yields are so low, companies are able to refinance at record low levels? What should we be comfortable holding? I think this is something that's going to be a real driver and a differentiator between portfolio returns in not just the next few months, but in the few years to come. We said at the beginning, maybe it was even said when I wasn't here, but we said that what we're looking to do at some point, and one of our biggest decisions is going to be when to go back into core equities. The second biggest decision behind that is how to go back into core equities. Does the S&P 500 get to a valuation where we think, yes, we'd like some of that, please, thank you very much? Or does it get to a valuation where we start to think, okay, well, maybe we could look at this from a sector perspective, maybe we look at it from a single stock perspective. The idea that we had when we developed our coronavirus strategy was putting it into the resilient basket and the recovery basket. All of the single stocks that Annie was highlighting sit in our resilient basket. They're the ones that we've been buying because they're the ones that we're comfortable owning. If Aliyah, if she skips on to the next slide, when we start to look at the recovery ones, they're the ones that we don't yet want to own. And the big question is when, followed by what. But I will pass back to Annie to talk through this side.
So we all love shopping. And now it's good time for some, maybe just me. So now it's good time for the risk-tolerant investors to actually do some shopping for recovery plays. There are certain sectors and single stocks which have been hit quite hard, and a lot of unloved blue chip names with huge potential recovery are actually trading at a very appealing valuation. Now, especially now that the panicking sell-off related to coronavirus data seems to be left behind us. So as Sam has mentioned, we have constructed a recovery basket which contains this type of stocks for opportunistic buying as soon as we see the indices level is at an attractive level. As you can see from the slides, the composition of the basket changes according to the market condition and the government response to the coronavirus situation. So in the very first version, we had airline and hotel names. For example, we had Delta, as the US government was providing huge funding through bailout, and also it has the strongest balance sheet among all the peers. However, now that we are negative on traveling tourism related names because we don't actually know when the countries are going to open the borders. We have replaced some of the names with consumer discretionary tech stocks, such as Adidas. So this month, a lot of countries in Europe are actually slowly loosening the lockdown measures and opening their economies. So the composition of the basket might change again in May, which is a critical month to understand, how effective the measures have been and whether the governments are ready to open the economies and how broad is the testing coverage. There might be a risk of resurgence of disease and second round of shutdowns, but we don't know. So one of the examples is Disney, which we have kept for both versions, who also reported revenue yesterday, generally in line with the market expectations. So we are all aware of the current challenges of the company. All the parks have been shut because of the coronavirus, and for sure the company will see some short-term pressure. That's why the company the price is being quite cheap, but we do believe the fundamentals of Disney remain strong, and it also has good balance sheet even after acquisition of Fox. So we expect investors to focus increasing more on the firm's long-term prospects rather than capitalizing on the EPS of 2020. A new entry is Adidas. So also we reported recently, we have seen strong growth across on the e-commerce side, which is linked back to one of our investment themes on e-commerce. It was actually up by 55% only in March. So we can see the demand on the e-commerce side remains very strong. And also the decision of maintaining marketing spend also suggests that the management is strongly committed to come out with prices in a stronger position compared to the competitors. So as we move to the last slide of the presentation, just to conclude the equity session, the coronavirus, which is this one I've talked about. So let's move to the next slide, which is the last one for the presentation. So the coronavirus crisis has brought the largest risk asset correction since the last financial crisis. So we all have seen the equities have posted a new low, but then also turn back higher very quickly. So markets still feel like a little bit squeezy, but the flows and position metrics suggest actually the participation levels to the long side are still quite low. So we have been receiving questions from our clients asking, so have we seen the bottom in equities yet? And more importantly, are people chasing this move? Cheaper valuations and the monetary policies that Jeff and James have mentioned, they might help in the bear market, but the global equities won't recover until investors actually see some improving macro data. Markets only find a sustainable base when there are signs that the money is actually feeding through the real economy, rather just temporarily supporting the asset prices. So overall, we are still underweighting equities, and within equities, we prefer US to the rest of the developed markets. As in fact, US is the most recession resilient market. And we also prefer the recession resilient sectors such as the info tech, healthcare, consumer staples, communication utilities. And emerging markets remain the least preferred markets as they're quite vulnerable to the global growth and the commodity prices. They also have less ability for monetary response for the upcoming wave of defaults. With that, I've concluded a section on equities. I'll pass it back to Simon.
Hopefully I can just answer one of the other questions that we had submitted, which was in relation to pharmaceutical stocks. I like the question, and it was one that we were kind of looking at last month as well. We don't have pharma in either our resilient or our recovery baskets. And there's a good reason for that. On the investment team, I think we're all somewhat intelligent people. We all have our interests in different sectors, different asset classes. We don't have any qualified, I say doctors. James is the closest that we get from a PhD perspective, maybe rather than actual medical qualification. So part of the issue from our side is, when we're looking at the current environment, we know that companies that have an e-commerce friendly business model are going to have not the same level of revenue drop off than companies that don't. So we can kind of stand here and guarantee that Amazon's revenue change is going to be more positive than Delta Airlines. Hence why one's in a resilient, one's in a recovery. When it comes to pharma, you're chasing this vaccine dream, and then you have a group of investment professionals who either have to take a complete punt on a single company in the hope that they are the one that manages to create, produce, distribute the vaccine around the world, or you have to have a sort of a diversified coronavirus vaccine basket. And then from our perspective, we don't really know which company is going to be the first across the line, when that's going to happen. And it kind of sits on that in-between slightly murky ground of companies that we want to own. The idea behind the basket is having either companies that we are very, very keen on. And the interesting thing that we found about the resilient basket was all of the companies that sit within that basket fit into what was our pre-COVID-19 thematic views of the world. So when we have been doing our Beyond Coronavirus series of webinar discussions, realistically what we're doing is looking at some of the thematic ideas that we had been exploring before the virus hit, and then looking at the opportunities that have come up for the stocks that we liked, and for many of them managed to buy at a discount to previous valuations when we were looking at them, but they're companies that we want to own for the next 2 to 5 years. Whereas on the recovery side, it's trying to have stocks that have balance sheets that are strong enough to withstand the revenue decline, or stopping in the occasion for some of them, to try and get that bounce back from the share price. So I think the idea of having pharma is an interesting, but it's a different game from the one that we're trying to play, and it's got slightly different rules. We're comfortable with the setup and the structure, and we'd rather play the sort of strategy game from something that we like, which is coming back to increasing emerging market consumer disposable income, e-commerce, video games, and there's kind of so many different positions in companies that we were following, and we've kind of had that opportunity to buy them or increase our position, that we kind of don't need to try and own everything that could have a sort of positive uptake in that regards. Any other questions from people that have come through? So a question for Dr. James. Views on oil. So before James answers, can I just say, James is running this Dolfin Discussions series of webinars looking at bond market, high yield, and there have been 2 videos that have now been done, and I'll market him because he won't, both of which have been discussions on the energy markets. They started looking at some of the drivers in the market that saw front month WTI go negative, but to get more insight and information on what has been happening in the energy space, specifically focused to oil, there are 2 really interesting videos that sort of delve into that into a lot more detail, but I'm sure James can give you a 30 to 45 second answer.
I'm not sure I'm capable of saying anything in 30 to 45 seconds, Simon, but I'm going to try. So in a nutshell, I think crude oil prices are going to spike. And I'd be reluctant to say how high and how long they would stay up there, but I would not be surprised if we saw Brent comfortably above $60 a barrel by year end or early next year. The price is less interesting to me. What I find really interesting is the dynamic that I think is going to drive this move in prices. If you think about what's happened over the past 6 weeks or so, there was a dramatic freeze in global economic activity, but in particular air transport and even road transport. So demand for crude oil just absolutely evaporated in a way at a large multiple of the biggest declines we'd ever seen in history, to the point where people just didn't even know how to respond to this kind of a demand shock and to these kinds of market moves initially. What happened was that we very quickly found ourselves in a position where we were going to exceed storage capacity. So if you think about the difference between the crude oil that's pulled out of the ground and the crude oil that's put into an airplane or into a gasoline engine, that difference between supply and demand has to go someplace. So if crude is pulled out of the ground, it's either going to go into demand or it's going to go into inventory. And if it's not going into demand or into inventory, then it's toxic waste. Well, once we started looking at exceeding inventory bounds because of this dramatic collapse in demand, supply had no choice but to rationalize. So we've seen a really dramatic curtailment in production, not just because of the OPEC machinated cuts, but very particularly in the US and the shale oil patch. Now roll this forward. Even a modest increase in demand, something that still is well below the levels of demand we had at the end of 2019, just a modest recovery in air travel, a modest recovery in personal travel by car, would pick demand up from these floors. But because supply was forced to rationalize in order to meet real-time demand at excessively low or sort of catastrophically low demand levels, that supply is not going to be there in 6 months. It takes time for supply to restart. You can't switch an oil well on and off like a light switch. So what's going to happen, I think, is that we're having seen crude oil prices collapse, negative prices, negative, extremely negative curve slope. At the end of the year, we're going to see inventories drawing dramatically, not because demand is suddenly surging, simply because demand is less bad than it was when crude oil suppliers were forced to rationalize their production. So I don't think that those high prices that I would expect to see by year end or early next year are necessarily here to stay. And I don't think that they're reflective of the long-term prospects for the crude oil market. I think it's the volatility that results from the stickiness that you get in commodity supply, demand, and storage. That was not 30 or 45 seconds, Simon, and I'm very, very sorry for that.
That's about as close as we can get. Just to finish up, obviously, apologies from my side with the fun and games on the technology. It was great to see my team taking the charge forward in my absence. Appreciate all of you logging on to watch. In terms of what we've got coming up, next week we're going to be continuing a little bit of a discussion on this idea of abnormal valuations in a post-COVID-19 world, and we're also doing a separate discussion on emerging market consumer disposable income, which is going to be pulling in some of the e-commerce and video games angles that we were talking about. And later this month, Annie will be sharing the first in her series of impact investment opportunities, and that's going to be over the next 4 to 6 weeks. So we'll have some interesting impact focused webinars coming your way as well. But in the absence of any more questions, thank you very much to everybody for joining, and we hope to see you at another Dolfin webinar event in the near future.